Imagine walking up to your dream apartment, finding the perfect first car, or finally preparing to launch that small business you've been planning for years, only to have it blocked by a single three-digit number. This number dictates our financial freedom, yet a shocking number of people do not understand how it actually works until it is already too late. Credit cards and the scores attached to them are deeply woven into our daily lives. They affect things from our phone contracts to our insurance rates. As college students preparing to navigate the real world, it is critical that we understand this. Understanding the system isn't just an academic exercise, it's a financial survival tool. Today, we're going to look back at the 1,000-year-long evolution of credit, break down the specific math used to calculate the scores, and debunk some widespread myths. Let's begin by looking at the modern concept of credit tracking and how it came to be. So, the modern credit system is built upon a deep financial history. According to a historical research paper published by Silver Lake editors, written records of credit accounts actually date back to the Babylonian and Assyrian cultures at the dawn of the Bronze Age. For centuries, however, credit was highly unscientific and highly unregulated. It relied entirely on a local merchant personally knowing and trusting you. The Silver Lake editors say that the actual concept of a physical credit card originated in the 1920s, when individual hotel chains and oil companies issued them to traveling Americans for company-specific purchases. The real game changer arrived in 1950 when the Diners Club first introduced the real general purpose card, which was followed by American Express in 1958. Soon after, the Bank of America launched the Bank AmeriCard, which is now known as Visa, which created the revolutionary system where a bank pays the merchant instantly and bills the consumer later. Now that we understand the historical background, we can examine the modern system of mathematics and how it evaluates your reliability. So credit bureaus use your financial data to calculate distinct scores based on precise mathematical formulas. According to the financial journalist Adriana Morga, a traditional credit score ranges from 300 to 850 and is built on 5 distinct percentages. The first one, 35% is your payment history, whether you pay your bills on time. 30% is your credit utilization, meaning how much of your available credit that you're using and how much is left available at the end of the month. And the rest of it is pretty small, 15% for the length of your credit history, 10% for the mix of different credit types like a mortgage, an auto loan, or a credit card, and then 10% are for the recent inquiries. The good news, as Morgan highlights, is that these scores are calculated purely on your financial management behavior. By law, the formulas are strictly forbidden to look at your race, age, gender, nationality, religion. It measures how much financial management you have with the money that you have, not how much you make. So a high-income earner can still have a terrible score if they're reckless. Because these mathematical formulas are kept relatively private, a massive wave of misinformation has spread about how it works. So let's talk about these myths. In her book, Your Credit Score, financial expert Liz Pulliam-Weston explained that a massive myth often repeated by real estate and loan professionals is that closing unused credit accounts helps your score. In reality, Weston notes that closing accounts narrows your credit utilization gap and shortens your credit history, which causes your score to drop. And another destructive myth claims that checking your own score lowers it. As both Morgan and Weston pointed out, the FICO formula completely ignores personal, soft inquiries, so you can check your score whenever you'd like. You can safely see the report anytime. And that's good because you want to catch things like identity theft early, or you can just check your score every day and see how you're doing on your utilization, so on and so forth. And protecting your score unlocks massive perks. Top-tier credit allows you to get rid of costly upfront deposits on utilities and also gives you a high advantage in competitive rental markets like Boston or New York. So, as we've seen, the way we handle our credit today sets the boundaries for what we can achieve tomorrow. So today, we track the journey of credit cards from the ancient Babylonian roots to the modern revolving network. We broke down the calculations behind credit scores, and we cracked open dangerous myths regarding closing accounts and checking your data. Your financial score is the ultimate gatekeeper to your future physical milestones. While a credit card and a credit score does not dictate your value as a human being, it completely dictates your financial future. Treating your credit score is important, so treat it like your physical reputation. Build it carefully, guard it closely, and use it wisely, so that when the time comes to build your dreams, The door is wide open. Thank you very much.